Hey everyone, welcome to today's Explainer. We are going to unpack something called the safety illusion. And honestly, it's a concept that's going to completely flip how you view your money. So grab a seat, step into my office for a minute, think of me as your financial mentor today, and consider this a bit of a cautionary tale. I'm here to give you a warning, especially for those of you who are young professionals just starting out in your careers. We're going to explore the invisible scripts that are quietly keeping us broke, those subtle little mistakes that feel so right in the moment, but are actually destroying your future wealth. All right, let's dive right into it.
Picture this for a second. You just landed your first real job out of college. You've been hustling incredibly hard, budgeting like crazy, and maybe skipped a few weekend trips with friends, and boom, you finally did it. You saved up $10,000. That is a massive milestone, and having that cash sitting there just feels like true security. Naturally, your instinct as a young professional is to fiercely protect it, right? You want to confidently lock that money away in what feels like a perfectly safe harbor, as far away as humanly possible from the wild, unpredictable roller coaster of the stock market. You just want safety.
So what do? Well, you do what basically everyone tells you is the smart thing to do. You take that hard-earned 10 grand and you march down to your local bank to put it in a fixed deposit, earning a supposedly guaranteed 6% return. You lock it in, you walk out of the branch, and you are literally patting yourself on the back for making the responsible, mature, conservative choice. You're thinking, hey, I'm making $600 a year and I have absolutely zero risk of losing my initial cash. It feels like a total slam dunk.
Okay, brace yourself, because here is the brutal math that nobody warned you about. You budgeted for a 6% gain. That's $600 on your $10,000. But suddenly, your 30% tax bracket swoops in to take its cut. The government taxes that interest, shaving $180 right off the top. So now your real gain is just $420. But wait, it gets worse. Inflation is hovering at 7%, meaning the cost of everything you buy out in the real world just went up by $700. You gained $420 in interest, but life just got $700 more expensive. You are mathematically in the red by $280.
You see, you didn't just choose the safe route, you unknowingly triggered this massive invisible chain reaction. And this right here is the tragic part of our cautionary tale. Because you calculated the return of your investment in absolute isolation, you totally ignored the chain reaction costs of taxes and the rising cost of living. What felt like a super responsible decision has actually mathematically ballooned into a guaranteed loss of your purchasing power. Like, sure, your money is technically safe in the vault, but what that money can actually buy you out in the world is silently decaying every single day.
Let's look at exactly how that decay plays out in the real world. Watch your bank account balance creeping up month by month from that fixed interest. It looks great, right? A nice, slow, steady climb. But now, look right next to it at the cost of the starter house you actually want to buy. That house price is compounding aggressively with inflation and market demand. The gap between your slightly growing bank account and the rapidly spiking price of that house is stretching wider and wider every single month. Your safe money is literally running a race it is mathematically guaranteed to lose.
And guess how long this takes to really hit you? 1 year. Within exactly one single year, that so-called guaranteed return quietly stripped you of your real purchasing power, and you probably didn't even notice it happening. It wasn't some sudden, dramatic market crash. You didn't fall for a terrible stock tip. It was just 12 months of the silent, relentless erosion caused by playing it entirely safe. The cash is still sitting there, yes, but its muscle, its actual value in the real world, has completely atrophied.
As your mentor, I need you to commit this next part to memory. You've become a victim of the safety illusion. It's this wild phenomenon where introducing a supposedly risk-free asset into your life actually kicks off a process of spiraling wealth decay. It is a trap uniquely designed to punish people who are just trying to do the right thing. You thought you were protecting your wealth, but by hiding from market risk, you actually guaranteed your exposure to inflation risk.
So why do we all keep falling for this? Honestly, it happens because of how we're wired biologically. As humans, we desperately crave emotional consistency and safety. When we open our banking app and look at a balance that never, ever goes down, our brains release this nice little hit of dopamine. We feel secure. And that biological need for comfort totally overrides our mathematical logic, making us calculate our returns in isolation while completely ignoring the real-world chain reaction happening right outside the bank's front doors.
And this deep craving for safety creates what we call the shifting baseline. When you use a fixed deposit or just a standard savings account as your anchor investment, it shifts your entire psychological baseline.
You get so incredibly used to zero volatility, so used to seeing a perfectly straight line, that the idea of any normal, healthy market movement suddenly creates immense psychological tension. You literally condition your brain to view normal financial growth as some terrifying roller coaster ride.
And right here is where the trap snaps totally shut. This psychological tension forces you to stay stuck in losing assets simply to match your newfound conservative identity. You start telling yourself things like, "Oh, I'm just not a numbers person," or "I'm just a cautious investor." But let's be real. What you really are is trapped. You are actively enduring long-term financial decay because stepping out of that perfectly safe, money-losing fixed deposit feels way too emotionally uncomfortable. You are paying a massive premium with your future wealth just to avoid feeling temporary anxiety. Let's compare two real-world paths side by side to make this crystal clear. On the left, we've got the cautionary tale saver. This is the young professional who seeks total emotional safety, hoards every penny of their cash in the bank, and literally watches their actual purchasing power melt away to inflation over the next decade. On the right, we have the strategic risk taker. This person understands the math. They accept the short-term volatility, and they actively use growth vehicles like index funds or real estate that historically outpace inflation. The saver feels perfectly safe but goes broke. The risk-taker feels occasional bumps, but builds lasting, generational wealth. Okay, so how do we actually fix this? I wouldn't be a very good mentor if I just pointed out the trap and left you there. I'm going to show you the way out. Here is your tactical escape plan for your daily financial management. If you want to put a hard stop to the invisible spiral of wealth decay, these are the exact rules you need to start applying to your paychecks today.
Grab a pen and take notes on these free steps. First, keep your guaranteed assets humble. Look, you absolutely need a basic emergency fund. We're talking 3 to 6 months of living expenses in a highly liquid account. But that is it. Keep it humble. Second, never ever lock up your entire life savings just to chase that cozy feeling of safety. The bulk of your money cannot live under a mattress or in a basic savings account. And third, practice strategic risk-taking. You must deploy your capital into real growth vehicles, things like equities, index funds, assets that actually have a fighting chance to outrun taxes and inflation over the long haul.
So what happens when you actually follow those steps? Well, by keeping your safe cash pile low, you effectively lower the silent, suffocating cost of inflation on your daily life. You completely prevent the psychological trap of emotional consistency from taking root in your brain. And most importantly, it gives you the mental and financial freedom to start stacking cash in vehicles that actually grow. You are shifting your entire identity from someone who hides from risk to someone who strategically manages it to build a massive future.
I'm going to leave you with this final challenge, straight from me, your mentor, to you. I want you to ask yourself honestly, is your need for emotional safety mathematically guaranteeing your financial decay? Are you truly willing to sacrifice your long-term wealth just to feel emotionally safe today? Don't let the illusion of safety rob you of the wealth you deserve. It's time to reevaluate your baseline, embrace some strategic risk, and start protecting your real purchasing power today. Thanks so much for joining me on this explainer, and I will see you all in the next one.